Prior to beginning the discussion today, I must read the following disclosures. Equity investments are affected by market conditions. The intrinsic value of the stocks in which our portfolios invest may never be recognized by the broader market. The opinions expressed are current as of August 3rd, 2021, but are subject to change. The information provided in this podcast does not provide information reasonably sufficient upon which to base an investment decision and should not be considered a recommendation to purchase or sell any particular security. Portfolio holdings are subject to change. The performance of any single portfolio holding is no indication of the performance of other portfolio holdings of any strategy or fund. Comments made on any individual companies or stock is not an indication that is currently held in a portfolio, nor is it an indication that it ever will be held in a portfolio. Hello, and thank you all for joining us for this financial services edition of the Gabelli podcast series. This is Terry Pope, a member of GAMCO's institutional team. With me is Ian Lapey, Portfolio Manager for the Gabelli Global Financial Services Fund and Co-Portfolio Manager of the Gabelli ESG Fund. For the next 20 minutes, I will host a conversation with Ian where he'll share investing insights and observations from the global financial services sector. Welcome, Ian.
Hi, Terry. Thank you for having me.
So let's begin with a recap. Were the global banks prepared for the COVID-19 pandemic? How did they perform in 2020?
Yes, they were very well prepared, and I think it's good to keep some history in mind here because prior to the last financial crisis, banks were in much worse position. And I'll just use Citigroup as an example. At the end of 2007, their assets to tangible equity was about 43 times compared to about 13 times at the end of 2019, so much, much less leveraged. And then another thing we look at is level 3 assets, which are assets that are valued based on models with unobservable inputs. So these are, very questionable assets. They actually accounted for 268% of Citigroup's tangible shareholders' equity at the end of 2007, compared to only 5% at the end of 2019. So, and other banks were similar, not as dramatic a change, but it's important. Citi fell 89% during the 2 years of the great financial crisis, and Citi and other banks certainly performed much better this time. So if you look at how they actually performed, first of all, it was a pandemic and they had to transition to working from home and deal with very volatile capital markets and strong demand from their corporate clients for loans and other investment banking services. And generally they did this pretty seamlessly. In fact, banks were really part of the solution instead of the part of the problem that they were during the great financial crisis. And then looking at their actual financial performance, it was very impressive because for the vast majority of them, they actually increased their capital ratios and also increased their allowance for loan loss reserves. So they are really in much, much better position, and they were able to do this without issuing dilutive equity, whereas, of course, many did during the last financial crisis.
So with so much stimulus in the pipeline, it was no surprise cyclical areas of the market came back to life. Cyclicals and the bottle stocks, as we call them, banks, oil, travel, and leisure, they led the market surge in the first quarter along with small cap stocks. So how are global banks performing today in early August 2021?
Yeah, it's very important to differentiate banks from those other oil, travel, and leisure sectors because for banks, the pandemic didn't create any type of a demand problem. As I mentioned, demand was very, very strong for their services, and they were able to fulfill that demand remotely. The other sectors that you mentioned all had major, and probably to some degree continue to have major pandemic-driven demand. So the businesses for banks performed really well. They proved to be very resilient. The stock prices have done okay, but as I'll get into later, they're still very attractive.
So can you expand on that with details on valuation for U.S. banks? And also, what about valuations for international banks?
Yeah, so for U.S. banks, for the ones that we hold in the fund, they trade at typically around or at a slight premium to tangible book value, about 8 to 12 times earnings, and have dividend yields in the sort of 2 to 3% range. The exceptions would be the trust banks, State Street and Bank of New York Mellon, which trade at about 2 times tangible book, given their much more resilient lack of credit exposure business models. And I would compare that, the S&P 500 trades at about 22 times earnings, more than 10 times tangible book value, and has about a 1.4% dividend yield. So I think the valuations of U.S. banks are extremely attractive. Now, globally, the valuations are even much better. In Europe, banks trade anywhere from sort of 28 to 80% of tangible book value, so huge discounts to tangible book value, also in sort of the 8 to 12 times earnings range. And they actually have excess capital that accounts for a huge percent of their market cap. And also in Asia, similarly, you have mid to high single-digit PE ratios and roughly 50-ish% of tangible book value valuations.
So how does the current investment environment in global banks compare to others that you've experienced throughout your career?
Yeah, in many ways it's more attractive, and the big difference is that the outlook is actually quite good. Oftentimes in my career in value investing, roughly 20 years, the best opportunities have been when the near-term earnings outlook is really bad. So, for example, following the financial crisis, or even a year ago during the heart of the pandemic. And that can work. Certainly, you can get good value opportunities if you take a long-term perspective and invest in companies that are strongly financed with good management teams. In this case, though, actually the earnings outlook is very healthy. As I mentioned, they have very strong capital positions, and they have very large reserves against credit losses, which should continue to be a tailwind for their earnings going forward.
So what about share repurchases? Are you seeing any changing trends, and what are your views?
Yeah, I think share repurchases can be, first of all, it's always better to invest in the business. But currently, demand for loans is not all that strong. And as I mentioned, the stocks are very attractively valued. So if you can buy back shares below intrinsic value, in which case the value of the shares for the shareholders who don't sell, like the fund, go up, then I think that's a good idea. Of course, only if you're strongly capitalized. You never want to buy back shares unless you have a very strong financial position. So what has been happening has been pretty remarkable, particularly in the U.S., and it's not just recent, and it did stop during the heart of the pandemic, but for example, banks have been buying back stock for years. Citigroup has bought back about 1/3 of their shares over the last 6 years, and Jefferies Financial Group has as well. Others like Ally Financial, Bank of New York Mellon, Capital One have bought back around 20% over the last 6 years. All of these companies have bought back shares during 2021. Outside the U.S., Japanese companies have been buying back shares, Japanese banks. European banks, not so much, but that really is changing. Just today, Standard Chartered and Societe Generale reported strong earnings and announced significant share repurchases. And last week, Barclays, NatWest Group, and BBVA similarly had strong earnings and announced share repurchases. So I think you're going to see continued share repurchases by the U.S. banks, and now European banks trying to catch up.
So let's pivot to the consumer today. As the economy opens up with vaccination progress, how are areas in consumer credit performing, such as auto loans and credit cards? Are there any risks?
Yeah, it's been really surprising because certainly during the pandemic I thought, and I think the management teams for the banks thought there would be significant losses in these areas. But the consumer has proven to be extremely resilient. I think underwriting was good heading into the pandemic, so that certainly, you didn't have an area like the subprime housing market during the financial crisis. So the consumer has performed very well. And just some numbers, so Capital One Financial every month announces, reports their delinquency information and charge-offs for credit cards and auto loans. As of the end of June, which was the last data reported, their credit card charge-offs are running at about half of the level that they were a year ago, and delinquencies are at about 2/3 of a year ago and less than half what they had been prior to the pandemic. In auto, actually net charge-offs are pretty negligible. Usually they run in the 1% to 2% range. So essentially, auto lenders aren't even losing money when their customers default. And the reason for that is used car prices have gone up quite considerably. And delinquencies in auto continue to be quite low as well.
So how do you view the recent stress test by the Fed and the European central banks?
I like the stress test a lot. As an analyst, it's very helpful information, and it's proven to be very successful. I think one of the reasons that the banks were part of the solution this time is that they do have to go through this exercise every year, which forces them essentially to be strongly capitalized. Just to give a sense of how severe the test is, in the U.S., it assumes 10.75% peak unemployment, a 55% stock market decline, and the default of each company's largest trading counterparty, 24% home price decline, and a 40% commercial real estate price decline. So even with this type of a stress, the vast majority of banks performed very well, and as a result, the Federal Reserve removed all the capital distribution limitations that were appropriately imposed during the COVID pandemic. That was, for the U.S., released in June. Just last week, Friday in fact, the European Central Bank released the results of its stress test. And similarly, the results showed that the banking system in Europe is very resilient to a similar type of a stress, and that many banks had, in fact, excess capital, and that's resulting in expectations for share repurchases going forward.
So 10-year treasuries rose above 1.7% at the end of March, although still low relative to historical averages. Can you talk a bit about how higher interest rates will impact banks and other financial services companies that earn profits based on net interest margin?
Yeah, so when I launched the fund in the beginning of October of 2018, the 10-year treasury was about 3.2%. And it fell all the way, I think at the low last year, it was at about 50 basis points. And I personally, I think that the general consensus, and I think it's generally true, is that low interest rates are bad for banks. But I think that there are several positives to low interest rates. It's very helpful for industries like housing and auto that benefit from low mortgage rates. Credit defaults tend to be much lower when interest rates are lower, and it's also very supportive to asset prices. So obviously, interest rates are very low right now. I am not an interest rate forecasting expert by any means, but you would think over the next 3 to 5 years, there's certainly more room for them to go up. And generally, I think that should be better. Terry, as you said, it is helpful for the net interest margin, but it does have negative impacts as well.
So over the past year, there's been much talk about digital acceleration as a result of the pandemic. So some businesses in the financial sector obviously benefited. Can you give us an update on these trends and how durable are they?
I think very durable. I think what a lot of banks learned is that they don't need as many branches because they had to close branches in many cases during the pandemic. And I think they've learned from that process, and a lot of customers were somewhat forced to embrace digital banking, and now they've continued to utilize digital banking. So as an example, Commerzbank, which is the second biggest bank in Germany, they're actually closing more than 50% of their branches. A lot of the branches that they closed during the pandemic, they just don't really see a reason to reopen, and this is going to be part of a restructuring plan that's going to reduce their annual expenses by about 23%. Similarly, here in the U.S., Webster Financial has already closed 17% of its branches, which is part of an effort to reduce its annual operating expenses by 8 to 10%. So I think it will continue to be an opportunity for improved efficiencies. And as I mentioned, the spending that the banks have been doing in the last few years, turned out to be very helpful as they were able to, move to digital operations. And there could be opportunities also from the learnings from working at home. I think that's still sort of under review.
So what other catalysts do you see in the financial services sector today?
Well, also sticking with the sort of the restructuring examples that I mentioned, another thing that banks are doing or have been doing in the last few years and are continuing to do is they're really, looking at their businesses and focusing where they have the most significant market share and best economics. So, for example, Citigroup is exiting 13 of its consumer banking businesses in Asia and the EMEA region just to focus on their 4 best areas: Singapore, Hong Kong, London, and the UAE. So what that has resulted in is less competition in each geographic segment. And that has coincided with a huge boom in demand for investment banking services. So with fewer competitors and strong demand, a lot of the investment banks have had just tremendous years in investment banking, doing things like underwriting IPOs, underwriting debt and equity issuances, advising on M&A. So that has proven to be very positive. And I think it's going to continue. The low interest rates, Terry, that you mentioned, that also is forcing banks, again, to figure out how to generate attractive returns at these very low interest rate levels. And that should be quite helpful when interest rates go up. The other area is consolidation. And, we've seen that happen. For example, First Citizens Bank shares last October announced a takeover of CIT Group, and this transaction was projected to be 30% accretive to tangible book value and 50% accretive to projected earnings. Now, you really hardly ever see acquisitions that are that attractive economically, and in fact, since credit metrics have improved since then, the returns should end up being even better. And also Webster Financial, which I mentioned, they're buying Sterling Bancorp, so combining a Connecticut bank with a New York bank, and this is going to be projected to be 20% accretive to earnings. So I think you're going to see continued M&A in the U.S. and in Europe. the ECB is actually encouraging banks to combine. They want their banks to be resilient and strong and are very conscious of the impact of low interest rates. So I think you're going to see more M&A in Europe as well.
So given everything we've talked about so far, valuations, company transformations, can you share with us some of your favorite stocks?
Yeah, so just a few. In the U.S., I like Citigroup. It trades at about 87% of tangible book value and 7 times earnings. In the U.K., Standard Chartered, which just reported phenomenal results today, is buying back stock. They traded about half of tangible book and 8 times earnings. And in Asia, I like Daiwa, which is the second largest investment bank in Japan, and trades at about 3/4 of tangible book and 10 times earnings.
So to wrap it up, one last question.
Sure.
How should individual investors think about their allocation to the financial services sector?
I think individual investors should invest with managers who use a long-term, bottom-up, fundamental investing approach, and also avoid areas where there's a lot of speculation and overvaluation. So given that, I can say personally more than half my net worth is in this the Global Financials Fund, because I do think valuations are very attractive, as I've been mentioning, and this is very much a long-term buy and hold approach, which I think is the best way that individual and all investors should invest.
Well, thank you, Ian, and thank you all for listening to Gabelli Media. We look forward to you joining us for our next podcast.
Thank you, Terry.
The following companies were mentioned in this show. Our company owns less than 1% of the following: Citigroup, ticker C; Capital One Financial, ticker COF; Commerce Bank, ticker CBK; Webster Financial, ticker WBS PRF; CIT Group, ticker CIT; First Citizens Bank Shares, ticker FCNCA; Daiwa Securities Group, 8601 on the Tokyo Stock Exchange; Standard Chartered, ticker STAN; and Jefferies Financial Group, ticker JEF.